Short exercise 14-2, we're going to be working with a mortgage payable. So, Ember Company purchased a building with a market value of $280,000 and land with a market value of $55,000 on January 1st. They paid $15,000 cash and signed a 25-year, 12% mortgage payable. So our first task is to journalize the purchase. And of course, record debits and then credits. So the first thing we're getting a building, $280,000. And because the building is an asset and the asset's going up, we're going to debit that asset, $280,000. And then we also get land with a market value of $55,000. So land is going up. And let's see, how did we pay for that? Ember Company paid $15,000 cash. So we know cash is going down. And cash goes down with a credit. And signed a 25-year, 12% mortgage payable for the balance. So the mortgage payable, which is a liability, that is increasing, so we have to credit that account. So how do we calculate the balance? Or how do we calculate this amount? You're going to take $280,000 plus $55,000 minus $15,000 gives us a balance of $320,000. And we need an explanation: purchase building and land with a mortgage and cash payment. We're excellent. Requirement 2, journalize the first monthly payment of $33.70 on January 31st. So notice we purchased the items on January 1st and it is now January 31st, so it's a month later. So we have to record 1 month's worth of interest. And that will be interest expense. And since the expense is increasing, I'm going to have to debit the account. So now, here's how we're going to calculate the interest expense. The formula for simple interest is principal times rate times time. So $320,000 is the principal. Where did I get that from? That's the mortgage payable. Times 12%, where did I get that from? That's the mortgage payable rate. And the time that has gone by is 1 month divided by 12 months. So I'll show you how you can do it on your calculator. If you like using the calculator in my accounting lab, we're going to enter the 320,000, 320,000 times 0.12, which is 12%, equals, and then divide that by 12. And that gives us our $3,200 of interest expense. To shoot that into this cell, I could just select the cell and hit this arrow. And it shoots it over into the cell and I don't mistype it. Let's see what else is going on here. The cash payment is $33.70. Now I'm going to skip a line. And cash is going down. So if cash is going down, cash is an asset. If it's going down, it is a credit. So I'm going to credit $33.70. Now notice these two numbers do not balance. Why? Because we also need to lower our mortgage payable by a little bit. And how much is that little bit? Well, it's the difference between $33.70 and $3,200. So you subtract those two, we get $170, and that is lowering our mortgage payable. Why am I saying lowering it? Because notice this is on the debit side, and to lower a liability, that's on the debit side. And then we have our explanation: paid principal and interest payment. So the principal is going down by only $170, and interest expense is the bulk of the payment, $3,200. And that's it.